The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody. I'm wishing everybody a happy Hanukkah, a wonderful Merry Christmas.
Kwanzaa.
And we finally know the tax law, but I will tell you, there's a lot of nuances as far as the business stuff that we're going to have to still pick through. But I think we can give you the highlights today. Our phone number here in studio is 8030930, 8030930, star 930 on a cell phone. And I told you it would snow.
It's beautiful. Yeah, it's gorgeous. Chris was
everybody was saying, oh, it's not going to snow on Christmas. It is snowing. I got Christopher Fabian and Tiffany Fabian in the studio with me. Hey, Tiff. Hey, Chris.
Hey, Esther.
Ho, 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 Esther.
So
wait.
I did the dastardly deed today.
I was going to say, I heard Santa came a little bit early to your house.
Yes, he did. And I'm like, the jury's out. I have 2 days to decide. But I got a puppy.
She's so it's a girl, right?
No, it's a boy.
Oh, boys are harder to potty train.
And his name is Buffy.
That's what
Buffy
I've heard.
Number 3.
Oh.
And he's so cute.
Oh.
Anyway, he's a golden doodle, and he is so cute. But oh gosh, the jury's out. I hope I can do this right.
Say a prayer.
I am. But so that was my last Christmas gift. That was it. That was my gift from me to my husband.
And he
so
loves
a
it.
Companion during tax season. Well, right now the dog is laying next to him, so that's a good thing. Right?
That's what it was.
That's a good thing.
Did you get a crate?
I got a crate. I
Good.
got everything. They gave me so much stuff when I left the store. I bought $400 worth of stuff. They thought, wow, we know we got this lady coming. Okay, so let's talk about, obviously we have a week left for the end of 17. And so what's really interesting is we're going to be doing 2017 with all its old laws, while 2018 with all the new laws are being phased in. And so we think we're really ready to help everybody with those two monumental changes. I know I was listening to the financial guys before our show started, and Mike was saying he wasn't so sure about it, and Glenn was saying, yeah, but it should be good for the economy. I don't think there's any doubt that this is going to be good for the economy, especially for the stock market and for corporations. My whole thing was the way it was originally written when it first went was from the House. It was not fair to lower income people at all. As a matter of fact, there's still a couple categories that are going to get it right in the neck, but they put back with the Senate a lot of the things that they were going to take away, and that's really good because these were very simple deductions that an average person could deduct, especially medical. I was really concerned about the medical.
Student loans.
And student loans, right. But those kind of things, I just thought, gosh, they're going to give a millionaire a $40,000 tax cut, and they're going to give a regular person maybe $50, $100. And I thought, gee, that doesn't seem fair to me. So a lot of the things that they said were not going to be in the law are still in the law, and we're going to talk all about that. But again, if you have any questions, 8030930, 8030930, star 930 on the cell phone. And before we go to the phone calls, you guys have anything you want to say?
I just want to say halfway through the year in January 2018, 33 offices open. On January 6th, Lewiston has an open house, and we're going to do a remote there. So on January 6th, make sure you stop in.
That's a brand new office.
Yep, stop in and say hello, and then we've got our app, and we're all ready to go.
And the app is the EG Tax Service app. It's absolutely great. It gives you so many tools. Even if you don't use EG Tax, use the EG Tax app. You can do accounting stuff. You can keep track of your income. You can keep track of your expenses. It has a receipt app, a part of the app to keep track of all your receipts and put them by category. You can you can ask a tax question. You can make a tax appointment. If you're our client, the stuff goes right into your folder. So it's a remarkable app, free app that we're offering out to the general public, and we're really happy about that.
Yep.
Right?
Yep. And
Okay. All right.
TV show.
Anything else? Chris, you got something?
oh, I was going to
Oh,
say,
a TV show, too.
yep, don't.
Tuesdays, starting in January 18th, 19th. I think it's 18th. The TV shows start on Tuesdays, about 5 or 6 o'clock.
Right, kind of ask the tax lady. It was do this, don't do that, but it's where you guys ask tax questions and we answer them, and it's a really great show, I think, to help you because when we answer tax questions, we don't just say yes, no, and talk in tax lingo. We talk in a way that people go, oh my gosh, I think I understand what they're saying, and that's our whole thing.
Yes,
Right?
yes. We put it in terms that anybody could understand.
Right. All right. Well, shall we go to the phones?
Sure.
Before we go to the changes in the tax bill? Let's talk to Steve. Hey, Steve, how can we help you, sir?
Hi, Esther. I've got a situation that reverts back to 2016 in regard to phase-out levels for things such as IRAs and Roth IRAs. I'm retired and I do a traditional IRA for the deduction while
So you're still working?
employed,
So
and
you're still working?
has a 401k, and she has a pension that's been frozen from years earlier. Do a Roth for her.
Okay, wait a minute. Steve.
Subsequently, do my
Steve.
contributions early in the year they're due rather than waiting till April 15th of the following. I pretty much do them in February of the year. So consequently, I made my contributions in February of 2016, not knowing that the income levels may come into play at that point. We were getting up to the level where they were phasing out, and I found, if I'm not mistaken, looking back at this, that I may have contributed to my traditional IRA, and only a portion of it may be that it was deductible, and it's mixed in there then with my traditional IRA. And the other end would be that my wife's contribution to her Roth IRA, I'm not sure whether or not that was eligible at the income level.
Okay.
Okay,
Hang on. Can I? All right. First of all,
You just,
Steve,
Who's
hold
working?
on, Steve.
who's working?
pardon me?
Who is working?
My wife is.
And you're retired, and she is working.
Yes.
And your income, and does she have a qualified pension plan at work?
401k she has.
Does she have a qualified plan through her employer to which she is
Contributing.
involved in?
I'm sorry it broke up, Esther. I apologize.
Yes, she has a 401k, so the pension
All right.
box is
All
checked.
right, so she does. All right, so may I ask what your combined income is, AGI, approximately?
Now, if I'm looking at that right, that's on the 37 line there, and it comes out to $191,453.
Okay, and how much of this was put into a traditional IRA?
$6,500.
Okay, so, and this was done February of 17?
2016. I have done one for 2017, but I'm sticking with 2016 first.
Okay, so he has commingled deductible with non-deductible contributions. So you want to explain to him about what he needs to do on his 8606?
So your non-deductible contributions would then flow over to the 8606, and it's almost like a Roth, but it's not. You can take it later on as non-deductible distributions, but it percentages it out over the life of the IRA.
So let's say you put in $10,000, and I know you didn't. You put in the $6,500, but just for easy math, let's say in your regular IRA, traditional IRA, you had $100,000, but you put in $10,000, which is now not deductible. That means when you start to do your withdrawal, 10% is going to be tax-free of all the money that you start withdrawing from your traditional IRA when you start to withdraw it. It's too late to make an adjustment. You can't reclassify. So you have to do your 8606, and you keep track of your basis that's going to be not taxable when you start to withdraw it, and that's what you need to do.
The basis would be the portion of the 6,500. Is that the basis?
That's not deductible. Would be your basis.
Portion of the 6,500. What was the limit for that? That just to clear to.
I don't have that off the top of my head, Chris.
Please.
You got a quick finder with you?
I do not have a quick
We're looking
finder.
it up
I was
online.
trying
But I'll
to.
tell you what you can do. You can Tuesday. Go to our
Office,
Give Tippers
call us.
a call, and they'll have all those things at their fingertips. I mean, we just can't bring everything, all those
Stand that.
limits in. But that's in effect what it's going to be, is all of the non-deductible portion of your IRA that you put into your traditional, part of that portion is going to be your basis on your 8606 that will carry through until you start to withdraw it.
Okay, given that, then real quick on the next scenario, I've already contributed for 2017 back in February of this year, and our income is over 200,000 this
So
year.
you really have to straighten out your 8606.
Or even eligible, if I'm not mistaken.
You need to straighten out your 8606.
He's
and
eligible.
that's true. If he wasn't
Contribute
even
to a traditional.
eligible, that's a problem.
But I think he's eligible, Chris, to contribute to a traditional if
If
he's off
right,
of his
if he
wife.
but if he put it in a Roth, that's a horse.
Right,
Right,
the spouse
horse of a different
yeah,
color.
the income limit for married joint, where your spouse has a retirement plan, starts phasing out at $184,000.
That's
on a traditional IRA.
Right. How about on the Roth?
On a Roth, it's 100 and
We were
hold
just
on.
working on this
I
with
just
Tim.
looked on it the other day. Roth IRA is 184 too. Also,
Right, so is he going to have a slight phase out, maybe?
yep.
Possible.
He should call us on Tuesday.
We'll work it all out for you so that you know what to do on your 8606.
All right, I have the chart in front of me, I believe, for 2017 that says the eligibility for a Roth with a joint return starts at 186 and is fully phased out at 196.
And you said it was 200,000?
Obviously, we're not.
Yeah, so
Yeah. Then you have to.
you definitely got to call us on Tuesday.
Yeah, we have several text-in callers too, Esther, for you.
Okay.
Well, thank you for your time.
All right, you're very welcome. That's why we suggest that nobody funds their traditional IRAs until after you see your tax advisor. That's why they let you do that up to the last day of the tax season,
Yep.
for filing, because when you take a shot at it and you put the money in there, you might not be eligible to do it. And so then what happens is your neat little IRA that would have been taxable when you take it out is only partially taxed, deductible or taxable, and you have to do this 8606 to keep track of the basis.
Right, and now with the new law too, you have to be careful when your financial person says, "Oh, let's move everything over to your Roth," because it could cost you $40,000, and by the time you come see us, we used to say, "Oh, forget it. Tell them to turn it back." You can't do
Frank
that.
is telling us to
move
break.
Right. Let's say you had a traditional IRA, and your investment advisor says, like Chris says, let's move it over to the Roth. Once you do that, you are in big trouble because you cannot reclassify under the new tax law back to a traditional. So when you're with your tax advisor and he says, "Oh, well, you owe $40,000," and the client drops dead on the floor and they say, "I didn't know that because my investment advisor didn't tell me that," too late. Once you're in the Roth, you're in the Roth.
Right.
So very important.
We got a break.
All right, I'm Esther Gullius, the tax lady from EG Tax. We're going to take all of your phone calls and we're going to tell you the tax law changes after the break, so we'll see you on the other side.
I don't want a lot for Christmas. There is just one thing I need when it comes to
I love this
being
song.
hungry.
Hey, I'm Esther Gullius, the tax lady, wishing you a Merry Christmas, Happy Hanukkah, and we're so blessed. And I have to tell you, I am so thankful that we get the opportunity to serve people, nice people like you, and I love what we do. I would
Yeah.
do it for free if I could pay if everybody would come to work and I didn't have to pay them. I would absolutely do it for free. quickly, I know that everybody's waited, but let's just quickly say this. One of the great things is, remember originally when we talked about that the bottom rate was going to go to 12%, they kept it at 10%. Hallelujah. So we're glad about that. Incomes all stayed the same. We've been complaining that alimony was not going to be deductible and is going to be, not taxable to the recipient and non-deductible to the payer. That will be true, but not until 2018 is over, right?
Correct.
So all
If you're getting a
divorces
divorce.
through 2018 will be the same, deductible to the payer, taxable to the payee. Going forward, that won't be the case. It'll be just like child support.
Right, so people can plan and talk to their lawyers.
Right. Under adjustments, everything moving's gone. You can't when you move.
For a job.
They don't care. It's not going to be deductible. But most everything else under adjustments stayed.
That's good.
Right?
Teachers stayed too?
Yeah.
Good.
Under itemized medical, yay!
And they lowered it to
My
7.5%.
God, and they lowered it so it's more advantageous.
That's awesome.
To 7.5% for 2 years. Taxes are still deductible up to $10,000. Real estate, state, and state sales taxes are still deductible. Interest is still deductible on whatever mortgage you had, but if you get a new mortgage, $750,000 is the maximum. They did say that, and I don't know because haven't gotten a copy of the bill yet, that home equity credit lines are not going to be deductible. So if that's the case and you have a home equity, you want to move it to a regular mortgage, but as soon as we get all the details, we'll let you know about that. Casualty is still deductible. They said that wasn't going to be, but yay, it's in there. And if it's a federally declared disaster area, we had a federally declared disaster area in Lake Ontario.
Yep, the safe harbor.
There's a safe harbor
provision.
Ruling on that. So up to $20,000, if you get an estimate from a contractor, you can take up to $20,000 on 16 or 17. Anybody else with casualty losses, as long as it's federally declared disaster area, you're good to go. And if you had a hurricane in any of the hurricane areas, you get special tax treatment.
Well, actually, with casualty losses, they're only allowed now for a federally declared disaster.
That's what I thought I was saying, but maybe I didn't, Chris. And then, of course, charity is now 60% deductible. Used to be 50%.
That's right.
And they're still allowing the transfer for the RMD from your IRA to a charity.
Gambling losses.
And gambling losses are still deductible. I just could think. I kept thinking.
The seniors.
I'm going to have to tell Stella, who went to the played a little bit of gambling.
Should we go
who
to
won
Tim
10,000,
before
but
the
lost
break?
10,000. She had to claim the 10, but not the losses. So okay, that's just the thumbnail. And businesses, mamma mia. Businesses are. Wait till we tell you about the business stuff. All right, but let's go to line 2. We got Tim. Hey, Tim. Hello, Tim. Tim from Tonawanda.
Hey, Esther, in 2018, how much has to be earned to get the earned income credit?
Well, first of all, how old are you?
Well, I'm calling for my son, actually. He's 38, divorced.
Okay. Does he have children that live with him?
They have joint custody, so the kids go back and forth.
But who is it that
Custodial.
the children live with, the custodial parent? Who do they spend the preponderance of time with?
My son is.
Pardon me?
The school system indicates that my son is, because they live in their district.
And he has them the greater period of time.
Supposedly the agreement is that they have joint custody.
But who has the children the preponderance?
Does he pay child support?
He pays a small amount, yes.
So that would almost seem
All right,
that.
well, all right. So we're not going to rule on this because
Yeah.
we're in no position. But here's the question: if he has income, how many kids do we have?
2 kids.
All right. If he has earned income of about $40,000 or less, he's going to qualify for the earned income credit if he is the custodial parent.
Okay, you got to be the custodial parent.
That's right. But here's the thing:
My understanding was,
how much does mom make?
I don't know, she doesn't make much, maybe 25 grand, something like that.
All right, so the truth is, mom would probably do better with the earned income credit if she's the custodial parent. And what we suggest is if we can get dad and mom together so that they can collectively, as a family unit, decide where it's better, who, so there's no fighting back and forth. That's what we would suggest. But I would suggest you have your son give us a jingle, and we'll take a look at the school records and things of that
But the
nature,
rulings
okay?
really haven't changed much, so you're going to be okay.
Right.
Do you get more money if you earn more money? Is that
No,
how?
the earned income credit is based on, it starts at as you earned income, and you have either you're a single tax, either a person that's lower income between the ages of 25 and 65, and your income's under like $12,000 and you have wages, then you can get a small earned income credit for that. Otherwise, if you have children that live in your home and you're the custodial parent, okay,
Yep.
then the earned income credit starts off for your wages, and once you get to about 15 or 16,000, you're around the maximum until about 18,000. Once you hit 18,000, it starts to go down. The whole thing with the earned income credit was that this is an incentive for you to go and work. So once you're working, they help you, but once you start making what they consider a lot more money, it starts to phase out.
It's a bell-shaped curve.
Okay?
Okay, you do his taxes and you do mine.
We got to go to news.
Well, we will take really good care of you. Give us a call on Tuesday, and we'll talk to you then, okay? Have a wonderful Christmas. I'm Esther Goulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. We're going to take a short news break. We'll be back on the other side. Oh my God, is that a Christmas song?
I believe he just said White Christmas.
Oh.
It is
Well,
a
that
white
is
Christmas.
not
This
my
is White
kind.
Christmas
I
by
like
Guns
the
N'
kind
Roses.
Like when they're up in Connecticut and they're ice skating. That's my idea of Christmas. All right? Hey, I'm Esther Goulias, the tax lady, 8030930, 8030930, star 930 on the cell phone. Also wanted to mention that the standard deduction is 12,000, 18,000 single, 12,000 head of the household, 24,000 married joint. They did that, but they took away the personal exemption. So don't think if you have children over the age of 17 or 17 or older that you're going to get this big break because you lose the personal exemption. Those are some of the people that are going to be hurt. And there are little pockets of people that are going to be hurt, and there's nothing you can do about it. It is the law of the land. The other thing is, let's see, we got this. And the tax rate at the top dropped by 3%. So if somebody's making $1 million, they're going to save about $12,000 in taxes. So that's a good thing. All right, let's go.
Are you laughing at your dog?
No, I'm not laughing at my dog. I'm thinking about how somebody who's making $1 million
Just saved.
to save $12,000. I'm thinking that a couple with kids should save the money, just because a kid is 17. But that's why I'm laughing. Okay, we're going to go back to the phones, and we're going to talk to Norm from Holland. Hey, Norm.
Merry Christmas, Esther.
Merry Christmas to you too, sir.
Hey,
sir.
I saw in the paper this morning there's an indication that they're proposing that you pay next year's taxes this year to take advantage of the
Nope.
you would have. Is that
Okay, so here's the thing. In order for you, and this is very important, if the taxes are levied upon you and you pay it with your money and it's your obligation to pay, then if you're an itemizer, that would make sense. Like, for instance, if you know that you're going to owe New York State, let's say $8,000 on April the 15th, obviously you would make that payment now because you're going to be able to deduct it as an itemized deduction if you're an itemizer, whereas next year you're probably not going to be able to qualify because they got rid of the personal exemption, but they doubled the standard deduction. So it's going to be harder for everybody to itemize. So, but your property taxes, if they are not levied upon you, then you can't deduct them. If your municipality is willing to bill you in advance, then and you pay those property taxes, then that would make sense. But it has to be your obligation, paid with your money, and it has to be your bill. So your municipality has to say that we levied those taxes in advance.
so you can't just send a check based on last tax and then
Nope. It's got to be your bill Your bill. If you don't have a bill, it can't be your bill.
You taught me that, Esther.
States that, if you did pay the taxes, you might owe more if the taxes were higher next year. So
Well, it's got to be your bill. And if there is no bill and you're just saying, here's some money from me, Norm, because I want to take the deduction, it doesn't work like that. It has to be your bill paid with your money on your obligation. And so they would have to be pre-billing you, and if that's not
And
the case,
that usually
it's not
doesn't happen.
no,
Okay.
so they're proposing in the paper, but it also indicated that you might be able to just pay like what you paid last year and then owe additional money when the taxes came.
Well, all I can tell you is you really would have to substantiate it then with the federal government, and unless the municipality said it was your bill, I think you would probably lose. So you have to say to yourself, is it worth it for $500 tax savings to do this? Only you can decide that. I can't, but all I can, I wouldn't do it.
Okay. Well,
Okay?
So I have to contact the town and the...
That's
And
right.
get a
Ask
bill
them to
now.
Send you a bill.
Okay, thank you very much.
Thanks, Norm. All right, let's go to Rick. Hey, Rick.
Hi, Esther. How are you today, Mary?
Marvelous. Merry Christmas.
Excellent. My wife and I own about 12 rental properties,
Okay.
and every one of them is paid off, so we have no mortgages on them. Other than our insurance and our property taxes, that's our only write-offs on that. And we get
And travel. You travel over to see them, right? You have repairs.
Take off.
And you have insurance, right?
yes,
Okay.
that is correct. But my biggest write-off on them is obviously my taxes on all these. And my wife and I are concerned about this $10,000 cap.
Oh, no. That has nothing. Everybody has to understand that when they're talking about the $10,000 cap, they're talking about itemized deductions. They're not talking about self-employment. They're not talking about rental property. They're not talking about corporations. They're talking specifically about the personal property taxes and personal real estate taxes that somebody is paying. That's what's capped.
So you're going to
Not
be
for somebody
fine.
That's in business, and you're in business, and so you're fine.
Well, there's all the properties are owned in our personal name. We don't have a corporation.
It's still on a Schedule E. It is deductible, and you don't have to worry.
That's because they wouldn't. Okay, that's huge.
Yeah, they're not touching page 1 of the
So
1040.
now you can have a Merry Christmas. You don't have to worry. You're in good shape. As a matter of fact, the tax law made it more liberal. Part of the pass-through deduction is going to people that have rental property. That has never happened before. So I don't know who has rental property. Does our president have rental property?
I think so.
He does. By gosh and golly, so he's going to get a big tax write-off for that. So REITs that couldn't have done it before are now going to be able to pass through. So you're fine.
Thank you. Merry Christmas, God.
Merry Christmas to you too. That's a wonderful thing to bless somebody, isn't it?
Yes.
All right,
Yes.
let's go to line 5. We'll talk to Mr. John. Hey, John.
Hello, Esther.
Hey, how are you, sir?
Hey, look, my question is simple.
Okay.
Charitable deductions.
Yep.
Well, I'm a itemized deductor.
Okay.
Itemized, and are those going to be a part of the itemized? And
Yeah, they haven't. They are absolutely. As a matter of fact, they said you can now deduct up to 60% of your income for an itemized deduction. But here's the thing: do you know how much last year your itemized deductions were, John? By any chance?
yeah, about 35,000.
Okay, you're good to go. So you'll be fine next year as well as this year. So yeah, you're good to go.
In other words, well, what about next year though?
No, you'll be fine.
Right, because what
the
Esther-
standard deduction is 24, and even if he's over 65, he's going to get his little extra deduction for that. But but now something you might want to think about is taking some of the deductions that you would have done for 18 and put them into 17 because you might be in a higher tax bracket on 17 versus 18. That's something you might want to fine tune this week.
That was exactly one of my questions.
Yeah.
And one other question: the basic rate. Now I pay almost 12%.
Uh-huh.
What's it going to be next year?
Well, so your income is about how high? You're single or married, sir?
I'm married.
So how much do you and your wife make approximately without your Social Security?
Without Social Security?
Yep.
Oh, about 60,000.
Okay, so you're going to stay right around, you're going to stay at 12%.
Yeah. This is my luck. Okay, well,
Okay. Well, it's such a blessing to see such a generous person. So have a wonderful Christmas and a Happy New Year.
Thank you.
Thank you, John. Okay, I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. Let's talk about those child tax credits. They're going to go from $1,000 for a kid up to age 17. So once they turn 17, you lose this, and it's now going to go to $2,000. So that helps to offset some of the personal exemption you can't claim. And actually, $400 of the $2,000. Well, actually, $1,400 of the $2,000 is going to be refundable.
Correct.
So some people with kids, I mean, this is a great time to have children.
Right, and they also increased the limit for married joint. It's instead of ending like $130, it's now $400,000.
Right. You mean
so
for people that can take the child
for
tax
people
credit.
who can take the child tax
Right.
credit.
So the child tax credit is very liberal, and that's wonderful. I think if your kids are turning 17, that you still got to love them, but in that 1 year, when they move from 16 to 17, your tax bill goes up a lot.
Yeah, I mean, before it was, you're going to get hit with $1,400.
Right.
Now it's $2,000.
Right, absolutely right. Right, and I don't know what the state of New York is going to do with that. So that's a major change. Pass-through deduction for those of you that are self-employed, subchapter S corporations. You're going to see that you can take a deduction of up to 20% of your of your wages that you paid in business on your Schedule C or your 1120 or your 1120S, provided it isn't a personal service corporation. But actually, if it is a personal service corporation, if it's considered personal service, and it's under 315,000, you're able to also take the 20% of what you paid in payroll taxes as a subtraction of the income that you've earned.
As long as you have payroll.
As long as you have payroll. So that makes you really want to rethink the way you've been paying people.
Yep.
So if you're self-employed, small business, partnership, and you want to run those numbers by us, give us a call. On Tuesday, we'll be very happy to run those numbers for you, because that can be a big thing, right?
Yes.
Okay, I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, wishing you a Merry Christmas, Happy New Year, and we're going to take a short break, and we'll be back on the other side. Now, I like that one. Frank, much better. Yay, Frank! Hey, I'm Esther Gullius, the tax lady from EG Tax, and we're talking about the upcoming changes of the tax law. Like our commercial said, it's really interesting this year because you're doing 2017 during 2018 with 2017 tax laws, but the 2018 changes, and there's a lot of them, are phasing in for 2018. So you want to make sure that you have your head screwed on when you're doing your tax return this year. That's for sure. Right, guys?
Right.
Hey, let's go back to the phones. We'll talk to Andy from Lancaster. Hey, Andy, how are you, sir?
Okay, I got a few questions for you, but basically they're simple answers.
Good.
The year 2018, I always claim miscellaneous expenses on Schedule A.
Not anymore, you can't.
Expenses gone in the year 2018.
Yep. All miscellaneous 2% itemized deductions are gone.
They're gone.
Gone.
Now, what about the ones that were supposed to end at the end of 16, such as the mortgage insurance premium? Is that alive or dead?
The MIP is still good through 17.
It's good for 7.
But that's an itemized deduction.
Not a
under interest,
miscellaneous.
Not 2%.
Minus deduction only.
Right.
Okay. And how about the tuition and fees deduction?
That's good. That's good through the change in the tax law. They left that in.
It's still in. Good.
Uh-huh.
And what about the residential energy credits? It has been here since 2005. Is it gone?
Kaput. Gone. Kaput. But they have kept in some of the solar credits, right, Chris?
Yeah, it's for solar panels and geothermal.
Right.
That's
but
still there.
Yeah, the plug-in car thing is gone.
Okay, now, I take.
But remember, that's 18. But 17, the plug-in car credit is still here.
Still. I also pay real estate taxes on a second home owned by my mom and dad. Can I legally in 2018 claim my real estate taxes and their second home that I own in my name?
All right. As far as I can, in 17, there's no problem. In 18, as long as it isn't capped by that 10,000, I think it's still good.
Still good.
Because nobody has said that you can't. But again, as we start getting these details, we'll let you know. But from what I can see, I don't think it's going to be a problem as long as it isn't over the $10,000 threshold.
Okay, now you also mentioned that all the exemptions are gone. That includes being over 65 and blind and whole.
No. The personal exemptions are gone, dependent exemptions are gone, but there is an increased standard deduction for being over 65.
But they talked about it for a while not being there,
Right,
but they added it
They
in.
put it back in. I mean, we were like dancing in the streets. We were so happy. I just kept thinking all of the regular people that were going to get,
But it's
whacked in the
it's
head,
there.
and so that's still back in there.
Okay, so being married and both my wife and I being over 65, will we get an increased standard deduction?
You're going to get your regular standard deduction of $24,000, plus you're going to get I think it's $1,300 a piece, right, Chris? You got that?
I think that's where it's about.
I think it's $1,300 a piece for being over 65.
Okay, Esther, I want to thank you very much. You people are beautiful, and I enjoy your program every Saturday.
Well, thank you so much. I hope you have a wonderful holiday.
You too, my dear.
Thank you, sir. I'm Esther Golias, the tax lady from EG Tax, 8030930.
And before we take the next call, I wanted to say real fast, going back to the previous caller, about paying the previous year's taxes. Right in the law, an individual may not claim an itemized deduction in 2017 on prepayment of income tax on a future taxable year in order to avoid the dollar limitation applicable for taxable.
Taxes, not income taxes. He was talking about property taxes.
But you're going back a color or so.
Right.
Yeah, but he was talking property, not income tax. But I think that principle holds true.
That was, right under the state and local taxes. So.
Okay, and then let's see, we got Paul.
Yep.
Hey, Paul, how can we help you, sir?
Merry Christmas.
Merry Christmas to you.
Okay, and I'm trying to come to grasp with the SALT limitations.
Yep.
And what qualifies is the state income tax and any local taxes, which would be, in my case, I live in Williamsville, Erie County, and school district taxes, right?
Right. And sales taxes.
And sales taxes. Okay.
Right.
Now, on my forms, though, so when we have the taxes you paid, would all three of those be included in that category?
All right, now you got to understand, 2017, there's no change.
Right.
All right, but going forward, it looks like what they're going to say is, what are your property taxes? What's your property taxes? Did you on your second home? What's your sales taxes? What did you pay in New York State withholding? And let's say if that figure comes to 12,000, they'll limit it to 10.
Okay, but if I go back to 16 and beyond, I just have my last 4 years worth of taxes in front of me. I'm not finding the school tax or all my taxes listed.
Well, didn't you include your school taxes in there?
Didn't you?
Yes.
Yes, that would be all included under the property taxes.
Yeah, we would have included it under property taxes. Yeah, absolutely.
All right, but it all should be included in that taxes you pay.
Absolutely.
Okay, and then and it wouldn't be anywhere else on the form.
Nope.
Okay, because you've done my taxes for the last.
So look, let's make sure that that's correct. Double check and let's see what your property taxes were, school and county, on all those years. And in the event that they weren't claimed, we can amend it and get you your money back.
Okay, all right.
Okay.
That sounds excellent.
Hey, and a really easy one, a texter said, is the blind deduction gone for 18? It is not gone.
Right.
It's back in there.
And we're so thankful for a lot of these things.
Yeah.
All right, let's go back to Bob. Hey, Mr. Bob.
Hello.
You got your Christmas shopping done?
I do.
Yeah, that's a guy. Most men leave it for
Weather
their
right
wives.
now, but I'm actually in a parking lot.
Shopping.
What can we help you with, sir?
Well, back to that property tax question, because I read that article that Cuomo put out about the property taxes. We own our house fully, so we're paying the school tax, the county tax, and the city tax in the city of Sioux Falls. They're due January, February, May, August, November, January. So my question is, I've already paid January 17.
So that's when they're due, but you've already been billed, right?
But I have a bill sitting there.
Then I would pay them.
End of January 18.
If you're an itemizer, I would pay them. If you got the bill, then I would pay them.
I've got the bill, and that would give me one extra, like $1,200.
There you go. If you're, like I said, if you're an itemizer, I'd pay them. If I got the bill, I'd pay it.
Yeah, the bill just says due before the end of January is what it is.
Good. There you go.
So I get a double, and I guess but that would count on the federal, right? Because I write.
Right. It's going to be deductible on the federal and also on New York State as an itemized deduction, because it was billed and it's paid with your money.
And I pay it up next week before the first.
There you go.
Smart
man.
Dated
Smart man.
2017.
Yep.
Wow. Okay.
Okay.
$300 or $400 in the pocket.
That's right. Hey, better in yours than somebody else's.
Okay.
Okay. Thank you. Merry Christmas. Okay, and we'll go back to Dave. Hey, Dave. How can we help you, sir?
Hi, sweetheart.
Hi.
Hi. This is a. I own one property that's in Pendleton, which is gouging the crap out of me. Collectively, between the county and the school, I'm paying almost $16,000 just one property.
Wow.
So, will I be able to write that off?
Is it a personal residence or is it business property?
It's personal.
Then you're going to be limited to $10,000, including your state withholding and sales tax and property taxes. So you're going to be limited to 10.
Right.
So you might want to consider relocating. I mean, the truth of the matter is many people are going to start making financial decisions based upon the limitation on their taxes.
Son of a gun. So collectively, if I own two houses, I'm one of these idiots who owns a lot of houses.
Well, if they're rental property, do you live in this house?
Yes, I live in that one house.
Okay, well, that is going to, like I said, it's going to be limited to $10,000.
So that's with everything, right?
That's with everything.
That's everything. So if you had your house here and you owned a house in Florida and you paid we'll say $25,000 in combined property taxes, you're going to be limited to $10,000.
On all taxes, sales tax, state income tax.
Son of a gun.
Yep. Hey, we told everybody. We told everybody.
You could do, though. I mean, what do you...
But you know what? I mean, the squeaky wheel gets oiled, and I think a lot of these things got back into the tax laws because I think a lot of people did complain. So, and you know what? It ain't over till it's over, so keep complaining.
Yeah, who do I complain to?
Well, I think your representative would be somebody who you would complain to, because he was one of the people that was quite a proponent in this tax law change.
All right, sweetheart.
Okay.
Thank
you.
Sorry.
Merry Christmas. Okay, and let's go quickly to Steve. Hey, Steve.
Hi, Esther. Merry Christmas to you and yours.
Merry Christmas to you.
Quick question. For 2016 and actually over the past couple of years, have I been able to deduct? I haven't deducted, but I just had a quick question. Can I deduct the premiums for long-term care insurance that I pay?
Well, if you can't itemize, then you wouldn't be able to. I mean, if you couldn't itemize your medical, you wouldn't get a benefit on the federal, but you would definitely get a benefit on New York State. Have you taken the credit on New York State for long-term care?
No, I never have, and
Well, then you have money coming back. They'll cry. You will make the governor cry. And
Yeah, how long have you been paying your long-term care?
For mine for 5 years and my wife's for 4.
Right, so we can go back to 14, 15, and 16 and get your money back from New York State. And we can try to use it as part of your itemized deductions as medical on the federal.
If you
have enough.
Substantial medical.
Right. I don't have enough, but I would then, sounds like, be able to get the credit or deduction to the state.
Right. And that'll save you some money.
That's all I needed. Thank you.
All right. Well, Merry Christmas. Let's see. Do we got time for one more?
Yep, real fast.
What do we got? Mike?
Yep.
Mike from Williamsville. Hey, Mike. Hello, Mike. Mike?
Yeah.
Okay, let's do...
Oh, wait. Mike,
Okay,
go ahead, Mike.
Are you there?
Hi, how are you guys?
Good. What can we do for you?
Merry Christmas. You
Merry Christmas.
your taxes, my whole family, you, Bill, your son-in-law,
Oh, that's great.
for years. So I had a couple of questions. You answered one of them about the $10,000 for personal residence.
Right.
So we have a permanent residence here, and we have a second home south.
Mm-hmm.
You still deduct both of those taxes if
Maximum $10,000 for all forms of taxes, property, state sales tax, and your income taxes on that state government. So the collective total cannot exceed $10,000.
So we shouldn't be affected there.
I don't know. It all depends on what you're paying in taxes every place.
Oh, okay. Yeah, it's
I mean, if you're paying $8,000 here, $3,000 in North Carolina, that's 11, and your state taxes to New York State are 3, so that's 14. You're going to be limited to 10,000.
Okay. All right.
Okay.
And the last question I have.
I think we
got
ran
it.
out of
We'll
time.
take you off the air,
take
Mike.
your-
We'll
your
take you
call
off the air.
I'm Esther Gullius, the tax lady from EG Tax. We are wishing you a wonderful Merry Christmas. We are thankful for all of you listening to our show, and I just pray for a prosperous new year for you. And if you need any tax help, EG Tax is the place to go. Have a wonderful Merry Christmas. God bless you guys. Bye-bye.